Hello friends, this is Marv Eisen from Timeless Dollar Trading Academy, and if you want to be successful, consistently successful as an E-mini trader, you've got to know a lot of information about the market. You've got to know the little picture, you've got to know the big picture, and of course, you've got to know how to trade, and that goes without saying. So let's do a recap of the past few days to give you an idea, an example of what I'm talking about. This is the chart of the E-minis on Friday, and this is the trading zone that I place on my chart every day using Taylor's numbers, which is a average of how far the market rises and falls each day. And there are 12 calculations that go into this, and while it looks simple, it's not really simple, but nevertheless, that's the piece of information, an important piece of information that I put on my chart every day, along with a black horizontal line that tells me where the market closed the previous day. But I said you need to know the big picture. So when I look at the big picture, of course, I know the history of the market, but I start with the economic calendar every day. And last week, on November 30th, the ADP employment report estimated 190,000 jobs would be added to the job market. When the report actually came out, the number was 127,000 jobs, far less than the 190,000 job estimate. Later that same day, at 1:30, Fed Chairman Jerome Powell made a speech at the Brookings Institution where he opined that the Fed would likely reduce the rate of interest rate increases. Now, interest rate increases have been 0.75 of a percentage point, a very large number, for 4 previous months. So, Fed Chairman Powell opined that the Fed would reduce their interest rate increases to perhaps 0.5%. Still significant, but a reduction. Lower interest rates would drive the market higher. That was on Wednesday, November 30th. Fast forward to Friday, December 2nd, the non-farm payrolls report was estimated at 200,000 jobs to be added to the job market, where in fact the report actually reported far greater number than the ADP report. So now the market is in a conundrum. Is the Fed going to increase interest rates 0.5%, 0.75%? We don't know. So that's the big picture, the economic calendar that you need to know every day. Let's fast forward. Again, looking at the big picture, this is the S&P starting in 2022. This is the beginning of the year, January 1st, 2022, where the market was trading at 48.45. Nice number. 2021 was very kind to the market, went up 30%. Unrealistic, right? Nobody could see that this 30% would be sustained. So in 2022, the market started out at that rate, but it has been decreasing steadily. And here we are, right here at December 2nd, 2022. And notice this horizontal line that I've drawn that is really denoting the resistance that the market has met throughout 2022. Significantly, right here, December 2nd, look at this. The market actually closed for 2 days in a row above the resistance for the entire year. So this is an important piece of information. Remember, in order to trade successfully and consistently, you have to know information. You have to know as much as you can about the market. You have to know the big picture. You have to know the little picture. So this is the big picture. And let me draw it out more clearly. This is the one-day candle. I'm going to make this a 15-minute candle. And I'm going to magnify this chart. And here you see the line of resistance. And you see that on December 2nd, prices closed above the line. And on December 1st, prices again closed closed above the line. And this is the only 2 days for the entire year of 2022 that prices closed above the resistance line. Very important. If prices close above this line, it really means that prices really want to go up. Now, also, seasonality has something to do with it. We're in December. The investment firms want to show their clients that they've done a good job for them, for their IRAs, their 401ks, and they want to show that they are making money for them. Difficult in 2022, right? But nevertheless, it's December. So in December, we have what's called window dressing. Common term in the industry, window dressing, which is to say the market wants to go up in the end of the year. The investment firms want to show their clients that they're doing well for them. Despite the fact that the market has gone down, still in all, the market wants to go up in December. So this is the big picture. Closed above resistance, yearly resistance for 2 days in a row. Okay, so let's now go to the more granular picture, the small picture. And this was the chart of December 2nd. This is a 3-minute chart of the E-mini. And I put my trading zone on my chart. And I have my previous day's close right here. And so what happened? Well, the market closed on December 1st, right around here, and was coming into December 2nd, right at the close of December 1st. Okay, everything is stable. And it's important to know where the previous day's close is, because that's where buyers and sellers feel that there's a value area. But look what happened. At 8:30, 263,000 jobs were added to the job market. That gave rise to speculation that maybe the Fed would not be reducing interest rates from 3/4 of a point to 1/2 a point. It sent the pre-market futures to a tailspin where they dropped 60 points in 3 minutes. Again, this is a 3-minute candle. 60 points, okay? And stayed there just about into the market open. This was 8:30, market open right here at 9:30, right over here at 40.29. That's where the market opened on Friday, December 2nd. So that brings us up to the history, the big picture, and now we're looking at the little picture. Okay, so you want to be able to trade profitably, and how do you make money on something like this? Well, there's 2 ways to look at the market. It's either going to go up, or it's going to go down, or it's going to go sideways. Well, when the market opens gap down or gap up, there's generally a good opportunity for a gap trade, meaning the prices will revisit where they closed the previous day. We don't know. But typically they do that 75% of the time, except when the market opens or closes substantially above or below where they closed the previous day. And this, my friends, was substantial, right? Okay. Here was the close the previous day, 40.80, and here's where the prices opened, 40.28. So significant drop in price. So the thinking could be, well, if the market is down, maybe it's not going to close the gap. Maybe it's going to continue to go down. But the gap does close 75% of the time. So we wait. And here, right here, okay, is where the market opened on Friday. I have my cursor at 9:30. You see 9:30? And here's my trading zone. This is where prices are likely to trade. And so we wait. Again, this is a 3-minute chart. Every candle is 3 minutes. We wait, and the market sort of gyrates, but look, it opened here, and then it went up a bit, then backed off. But where did it back off? Here was the open at 40.28. It backed off to 40.30. It didn't back off. It didn't test the 40.28. So that gave rise to the hint that prices would rise, would make up the difference, this big drop. And in fact, this was a knee-jerk reaction, and experienced traders would know that this could be a knee-jerk reaction to a report that came out pre-market, and the prices were going to revisit previous levels, which in fact they did. But And I want to call your attention to the fact that they did actually close the gap. Right here, they closed the gap, but not until 3:15 in the day, far later than the open. But where did they go and stop beforehand? Right at my calculated trading zone support level at 40.65. These trading zone support numbers, they are not 100% accurate because nothing is, but they are very accurate because professional traders use them. They've been accurate for 75 years. And so it's an important piece of information in conjunction with your indicators that you should use on the chart if you want to be consistently successful. If you want to know how to calculate these numbers, I show you the actual formulas in my course at timelessdollar.com, Trading Mastery for Financial Freedom. Or you can buy George Taylor's book and try to divine them. It's a very difficult book to read, and he does not give the formulas. I give you the formulas, okay? And so you can put this on my chart, on your chart. But in the interim, it's not going to be easy for you to formulate George Taylor's numbers. Be happy to give it to you every day. Go to my site at timelessdollar.com and you can get my daily trading zone subscription. But at any rate, the thinking for experienced traders was that this is a knee-jerk reaction and prices were going to revisit the previous numbers, and which they did. So this rewarded traders, how much? 60 points. But nevertheless, if you want to be a consistent, successful trader and you need to hit the home runs in order to do so, Friday, December 2nd, this was a home run. Thanks so much for watching. Trade safely. Use lots of patience when you trade. There are only 2 or 3 good trades a week. Thanks for watching, and I'll see you in my next video. Marv Eisen for Timeless Dollar Trading.